Let's get started. Start with listening, and then learn new words and practice them in sentences.
Ever wondered who's the real powerhouse steering the colossal ship of America's economy? The answer is the Federal Reserve. The Federal Reserve, often referred to as the Fed, is no ordinary bank. It's the central banking system of the United States, a network of 12 regional banks, each serving a specific geographic area, all under the watchful eye of the Board of Governors based in Washington, D.C. But why is the Federal Reserve so important? Well, it's been handed a pretty significant mandate. Its primary mission is to promote economic stability in the U.S., and it does this by focusing on three key objectives: price stability, full employment, and sustainable economic growth. Let's break that down. Price stability means keeping inflation, the rate at which the general level of prices for goods and services is rising, in check. When prices are stable, people can trust the value of their money tomorrow will be roughly the same as today. Full employment doesn't mean everyone has a job, but rather that those who want to work and can work do work. And sustainable economic growth? That's about ensuring the economy keeps expanding but not so fast that it becomes unstable. So how does the Federal Reserve achieve these goals? It uses a variety of tools and mechanisms to influence the economy. For instance, it can adjust the discount rate, which is the interest rate charged to commercial banks for loans obtained directly from the Federal Reserve. It can also alter reserve requirements, the minimum amount of funds that a bank must hold in reserve against deposit liabilities. But the Fed isn't just about keeping the economy on an even keel during normal times. It also steps up in times of crisis, such as the financial meltdown in 2008 and the COVID-19 pandemic, using its tools to stabilize the economy and promote recovery. So, the Federal Reserve isn't just a bank, it's the lighthouse guiding the U.S. economy through choppy waters. Now, you might be asking, how does the Federal Reserve manage such a Herculean task? Well, they have a unique toolbox at their disposal. First, let's talk about open market operations. This is the main tool the Fed uses in which they buy or sell government securities, such as bonds, in the open market. When the Fed buys these securities, it increases the amount of money in the banking system, making loans cheaper and encouraging spending. Conversely, when the Fed sells securities, it pulls money out of the system, making loans more expensive and slowing down spending. Next in the toolbox is the power to adjust the discount rate. This is the interest rate that the Fed charges banks for short-term loans. Lowering the discount rate makes it cheaper for banks to borrow money, which they can then lend to their customers. Raising the discount rate has the opposite effect, making it more expensive for banks to borrow and therefore slowing down the economy. Lastly, the Fed has the authority to set reserve requirements. This is the amount of money that banks must keep on hand and not lend out. Higher reserve requirements mean that banks have less money to lend, which can slow down economic activity. Lower reserve requirements allow banks to lend more money, potentially stimulating the economy. So, how does the Fed decide which tool to use? It depends on the economic situation. In times of economic downturn, the Fed might use all three tools to stimulate spending and investment. In times of inflation, the Fed might do the opposite to slow down the economy and keep prices stable. These tools are not used lightly or in isolation. They are part of a complex strategy designed to manage the nation's money supply and keep the economy stable. And, like any strategy, it needs to be adjusted as conditions change. Thus, these tools enable the Federal Reserve to fine-tune the economy, much like a maestro conducting a symphony. But what about when the economy hits a roadblock? The Federal Reserve steps up to bat. Imagine a car journey. The car represents our economy, the road represents the financial market, and the Federal Reserve is the driver, ensuring the car stays on course. But what happens when there's a major pothole in the road, like the financial crisis of 2008 or the COVID-19 pandemic? The Federal Reserve doesn't just sit back and watch the car crash. No, it takes swift and decisive action to navigate the car through the rough patch and back onto smooth pavement. Let's take a closer look at the 2008 financial crisis. When the housing bubble burst, it sent shockwaves throughout the economy. Banks were failing and the economy was on the brink of a deep recession. The Federal Reserve stepped in, utilizing its toolbox of monetary policies to stabilize the economy. It slashed interest rates to near zero, making it cheaper for businesses and consumers to borrow, thus stimulating economic activity. It also implemented a series of unconventional measures known as quantitative easing. effectively pumping money into the economy to boost liquidity and restore confidence in the financial market. Fast forward to the COVID-19 pandemic. The economy faced a different kind of roadblock, one caused by a global health crisis rather than a financial one. Yet, the Federal Reserve was once again ready to respond. It cut interest rates to near zero and launched an even more aggressive round of quantitative easing, buying up government and corporate bonds to ensure that money kept flowing through the economy. In these instances, the Federal Reserve demonstrated its resilience and adaptability. It showed that it could react quickly and effectively to economic shocks, using its monetary tools to keep the economy afloat. It's like a seasoned driver, adept at navigating through any terrain, no matter how rough the road may be. In times of crisis, the Federal Reserve proves to be an economic knight in shining armor. However, with great power comes great responsibility and controversy. The Federal Reserve, or the Fed, as it's often referred to, isn't immune to this. As it navigates the choppy waters of economic stability and monetary policy, it faces several challenges and controversies. One of the most significant issues revolves around transparency. The Fed's decisions impact the lives of millions, if not billions, of people, not just in the United States but around the world. Yet the processes and reasoning behind these decisions often remain shrouded in mystery. Critics argue that a more open and transparent approach could lead to greater public understanding and trust. Independence is another hot topic. The Fed is designed to be independent from political influence, allowing it to make long-term decisions that are in the best interest of the economy. However, this independence can sometimes be questioned, especially when political pressure mounts for short-term gains. Accountability, too, is a significant concern. The Fed has a monumental task of managing the country's monetary policy. But who holds it accountable? While it is subject to some oversight, many feel that this isn't enough, given the magnitude of its influence. Speaking of influence, the Fed's decisions reverberate far beyond the borders of the United States. Its policy changes can cause ripples in global financial markets, affecting individuals, businesses, and governments worldwide. This global reach, while necessary in an interconnected world, raises questions about the broader implications of its actions. It's a delicate balancing act. The Fed must weigh its mandate to promote price stability, full employment, and sustainable economic growth against these challenges and controversies. It must also consider its global influence and the potential ramifications of its decisions. So, yes, the Federal Reserve isn't without its share of controversy, but it's also worth remembering that it has a vital role to play. It's the engine that drives America's economic stability, shaping the financial landscape for millions of people. Despite the challenges, the Federal Reserve continues to play a crucial role in maintaining economic stability, proving that it's indeed the powerhouse behind America's economy.
Let's learn new words and practice English with the topic, the role of the Federal Reserve at level B2. Federal Reserve. Federal Reserve, the central bank of the United States, responsible for setting monetary policy and regulating banks. Example, the Federal Reserve plays a crucial role in managing the nation's economic stability by adjusting interest rates. Monetary policy. Monetary policy, the actions of a central bank, currency board, or other regulatory committees that determine the size and rate of growth of the money supply, which in turn affects interest rates. Example, the Federal Reserve uses monetary policy tools like open market operations and reserve requirements to influence the economy. Interest rates. Interest rates, the proportion of a loan that is charged as interest to the borrower, typically expressed as an annual percentage of the loan outstanding. Example, the Federal Reserve adjusts interest rates to control inflation and stabilize the economy. Inflation. Inflation, the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Example, controlling inflation is a significant challenge for the Federal Reserve, as it affects everyone's cost of living. Economic stability. Economic stability, the absence of excessive fluctuations in the macroeconomy, marked by steady growth, stable prices, and low unemployment. Example, the Federal Reserve aims to maintain economic stability by using its monetary policy tools to respond to economic fluctuations.